Okay, hi there and welcome to Test 8 in our series The Edge in Economics Revision. We take a topic, this time it's competition policy, and we ask you 5 multiple choice questions so you can check and test your understanding. Here's the first question. It's to do with energy. Ofgem, the energy regulator, has introduced price caps which limit how much suppliers can charge for customers who use a prepayment meter. If energy companies in the UK charge non-prepayment households more to cover any loss of profit in a price-capped market, what is this an example of? Take a moment, press the pause button, have a go at question 1. Okay, so regulatory intervention in the market, capping prepayment meters. Firms decide to charge more to people with non-prepayment meters. The right answer is A. It's an example of third degree price discrimination. They're supplying the same energy. It's the same energy that goes through the pipes and things. They're charging a higher price for people with a non-prepayment system. That is an example of price discrimination to increase their revenues to cover the loss of profit. Here's question 2. The big supermarkets in the UK are often accused of using their monopsony power to pay lower prices of milk and dairy items, therefore putting dairy farmers out of business. Government restrictions on monopsony power may do what? Take a moment to answer question number 2. So what do we think for question 2? A topical question about monopsony power. Government restrictions on monopsony power may, the answer is B. Protect suppliers and employees from market power. In other words, the government may step in, for example, the groceries adjudicator, or setting some sort of minimum guidelines for the contracts between suppliers and supermarkets to try to make their relationship more commercially viable, more equitable. And of course, if those suppliers are making more money, in theory, they can pay better wages to their employees. Here's question 3. Many small and medium-sized businesses in the UK suffer from banking inertia and therefore may be paying more than they need to keep their business financial affairs going. The government launched the current account switching service aimed at SMEs and consumers, aiming to make it easier to switch providers. This is most likely to be an example of what? Have a go at question 3. So trying to get more consumers and small businesses to perhaps think about switching their bank accounts. The answer is C. Competition policy to reduce market power. This is a good example of intervention designed to make it easier to switch. And the key point here is if more people switch or threaten to change their bank account, maybe they're not getting a sufficiently good rate of interest, or maybe the quality of service isn't particularly good. If more people switch or threaten to switch, this then means that the banking sector becomes more contestable. Established banks more at threat from challenger banks. 2 more questions. Question number 4. Which of the following examples are likely to be classed as natural monopolies in the UK? Which of the following most likely to be classed as natural monopoly in the UK? Now, let's take a moment, have a think about question 4. So what do we think? 3 industries, of which of those are most likely to be classed as natural monopolies? The answer is D. Network Rail, the National Grid, the Royal Mail. NHS and police force are not natural monopolies. Police force is essentially a quasi-public good, the NHS a merit good. Those 3 examples at the bottom, the rail industry, the infrastructure, the National Grid for electricity and gas, the Royal Mail, they're all infrastructure businesses that require a national grid and network system, and therefore come close to that of a natural monopoly where the fixed costs are really high, tremendously high fixed costs of running the network or the grid. The marginal cost of supplying to each household, to each passenger, is pretty low. 1 more question on this little test. Which argument might be used to justify a policy of nationalisation? Press the pause button, have a go, please, at question 5. Which of those policies, arguments, A, B, C, or D is the best justification for nationalisation, taking a business from the private sector to the state sector? Well, the answer is D. Profits from a state-owned business can help government finances. Assuming that a state-owned business makes a profit, then the money goes to taxpayers, the government, rather than to shareholders. Well, nationalised industry, of course, shareholders are the whole population. B would be sounds plausible, doesn't it? But B would be more like a natural monopoly. And nationalisation is not necessarily with a natural monopoly. It's not the same thing. A, of course, is a justification for the private sector operating, because the stock market and the bond market act as a kind of discipline on firms' costs. And of course, if it's nationalised, well, there aren't any shares. So therefore, the stock market is not a particularly strong discipline on a firm. There we go. There's 5 questions for you on competition policy. Hopefully you got some good answers there.